Welcome to Griffonomics.
Glad to be here for this one.
So last year, UPS did something that sounds, frankly, like absolute corporate suicide.
Oh, yeah. Totally counterintuitive.
Right. They deliberately threw away millions of Amazon packages. I mean, they looked at the biggest e-commerce machine on the planet and essentially told them to, take their boxes elsewhere.
Which is just wild to think about.
It sounds insane on the surface, but as we're going to explore today with you, it might actually be the most brilliant margin recovery strategy in modern logistics. We've got a massive stack of sources for this deep dive Q1 2026 earnings transcripts, Raymond James institutional slides, and those SEC 10K filings.
Lots of dense material to get through.
Yeah, but our mission today is to give you a granular strategic report and an investment roadmap on this monumental pivot. We're looking at how a 118-year-old titan of industry is aggressively shifting from a volume-driven behemoth to, well, a highly specialized high-margin self-help story.
And it really is a self-help story at its core.
Okay, let's unpack this. Because if we want to understand where UPS is heading, we have to look at the fundamental rule of logistics they're completely abandoning.
Yeah, the rule they're abandoning is basically the foundational assumption of the entire parcel delivery industry, which is that scale equals profit.
Right, just get bigger.
Exactly. For decades, conventional wisdom was just, chase raw volume. You want as many cardboard boxes moving through your trucks and planes as possible. The logic was that maximum network utilization would spread out your fixed costs and essentially cover up any underlying inefficiencies.
But UPS management is just throwing that out the window now.
They are actively overturning it. They're executing this new corporate philosophy they call better, not bigger. They are no longer chasing volume at any cost.
Which has to freak out your standard growth investor, right? I mean, growth investors usually panic when they see volume drop. But the sources show UPS is orchestrating this drop on purpose. What kind of numbers are we talking about here? How much volume are they actively shedding?
The numbers are massive. I mean, just looking at the Amazon account alone, UPS reduced those low-margin packages by 1 million pieces a day last year.
1 million a day? Wow.
Yeah, and they're on track to cut another 1 million pieces a day in the first half of this year, 2026. In Q1 alone, their average daily volume, or ADV, dropped by 500,000 pieces.
So they're seriously cleaning house.
They really are. And furthermore, well, I should say, they're taking a significant portion of their ground saver volume, which are those, less lucrative, slow residential economy drops, and just handing them off to the U.S. Postal Service to do the last mile.
So if you're sitting there listening to this, the obvious question is why would a logistics company refuse to deliver packages?
I like to think about it like a restaurant. Imagine this famous local diner, right? There's a line out the door every single day for their $5 cheap lunch special.
I love this analogy. Right, so the dining room is packed, the cooks are exhausted, the volume is massive. But at the end of the month, the owner realizes the profit margin on a $5 meal is basically zero. So they shut the doors, tear up that cheap high-volume menu, remodel the place, and reopen exclusively taking high-end Michelin-star dinner reservations.
Exactly. From the outside, it looks like they're losing thousands of customers. Less foot traffic.
Yeah, but internally on the balance sheet, the business is actually becoming highly profitable.
That is the exact dynamic playing out here. By removing that low-margin clutter, UPS frees up capacity to serve a much more lucrative clientele.
So then the critical question for you as an investor becomes, what is UPS putting on that Michelin star menu? What replaces those millions of Amazon boxes?
Well, management is aggressively targeting small and medium businesses, SMBs, and business-to-business logistics. But the absolute crown jewel of this better, not bigger strategy, the real profit driver, is healthcare.
I noticed that. There was a huge emphasis on healthcare in the Q1 transcripts. It just seems like a very specific niche to bet the farm on.
It's a massive niche, actually. And UPS is already the world's largest healthcare logistics provider.
But we need to define what healthcare logistics actually means in this context.
Right, we're not talking about dropping off a bottle of aspirin at a pharmacy.
Exactly, no. We're talking about highly complex cold chain supply networks. These are, clinical trial drugs, super sensitive biologics, specialized vaccines, and the strategy is paying off right now.
They hit a milestone in Q1, didn't they?
They did. In Q1 2026, for the first time in the company's history, UPS generated a $3 billion revenue quarter strictly from this healthcare segment.
$3 billion just from healthcare.
Yeah.
And when you look at the mechanics of why that segment is so profitable, It all comes down to pricing power. I mean, think about it. If you're a retailer shipping a basic cotton t-shirt to a suburban house and your shipping carrier raises prices by 5%, you're going to be
Oh,
furious.
you'd switch carriers immediately? Right, because the margins on that t-shirt are razor thin. But if you are a pharmaceutical company shipping a temperature-controlled clinical trial drug, a drug that literally determines the fate of a billion-dollar research project, you do not care about a 5% shipping price hike.
Not at all. You care about 99.99% reliability.
Exactly. And that creates a massive economic moat.
Precisely. The price elasticity of demand for a highly sensitive biologic is incredibly low. But, building that economic moat creates a very real physical problem for UPS.
Because you can't serve a Michelin star menu out of a greasy spoon kitchen.
Exactly. A box of liquid nitrogen-cooled vaccines cannot just be tossed onto a standard, dusty warehouse conveyor belt next to, like, a pair of sneakers. It requires specialized handling, sensors, speed.
Which means the physical buildings and the trucks have to change. You can't just pivot your strategy on paper. You have to physically rebuild the entire machine.
Yes, and that physical rebuild is what UPS calls the Network of the Future initiative. This is the largest, most aggressive network reconfiguration in their 118-year history.
That's saying something.
It really is. It's about right-sizing their physical capacity to perfectly match this new, complex volume profile. And they've set a very specific, aggressive $3 billion cost-out target for 2026.
Wait, how do they actually pull $3 billion out of their operating costs in a single year? What are the actual levers they're pulling on the ground?
So it's a multi-pronged approach. First, they're removing 25 million operational hours from the network. Second, they're closing down older, less efficient facilities. They're targeting 27 facility closures this year alone, and they moved incredibly fast.
Yeah, the sources said 23 of those were already shuttered in Q1.
Right. But the most significant and definitely the most difficult aspect of this transition is the human capital. They are eliminating 30,000 operational positions.
Ouch. Now, whenever a company announces they're slashing 30,000 jobs, closing dozens of buildings, and cutting 25 million operational hours, the immediate reaction from the market is usually fear.
Right. It sounds like panic.
Is there a risk that this isn't actually an optimization strategy, but rather just a shrink-to-survive scenario? I mean, if overall volume is dropping because they shed Amazon and they're just cutting staff to stop the bleeding, that sounds like a managed decline.
That is the exact skepticism many analysts brought to the earnings call. And it would absolutely be a shrink-to-survive strategy if the story ended with those cuts.
But it doesn't end there.
No, the causality here is completely different. What's fascinating here is how they are managing this human capital shift, specifically with this voluntary driver choice program. That safely reduced about 7,500 full-time driver positions without forced layoffs.
Oh, so they're offering buyouts, essentially.
Exactly. They're eliminating the old manual high-maintenance legacy network and simultaneously injecting massive capital into advanced automated hubs. They're building the infrastructure to handle that premium volume at a lower cost.
Okay, so it's a substitution of manual labor for automation, not just a desperate subtraction to save cash. Let's explore the mechanics of that substitution, because the tech metrics in the sources are moving incredibly fast.
They really are. Management stated they're expanding automation into 15 or more hubs in 2026. Right now, 67.5% of their buildings are automated, and they are marching steadily toward a 68% target.
Now, when you look at a fractional percentage like that, your first thought is probably going to be, why does a 0.5% increase in building automation matter to my portfolio? Like, what's actually happening inside those buildings?
The answer lies in a metric called CPP, or cost per piece. The data shows that the cost per piece in an automated UPS building is a staggering 28% lower than in a non-automated one.
28%, that's huge.
It's massive. The overarching goal of this entire transition is to drop their overall cost per piece into the low single digits by the back half of this year.
Let's visualize how that 28% cost reduction actually happens on the floor. Instead of a worker physically picking up a cardboard box, searching for the barcode, and scanning it with a handheld laser gun, which, maybe takes 5 seconds per package, UPS is rolling out RFID tech.
Yeah, the RFID rollout is a game changer.
They're installing RFID readers across 5,500 UPS stores and putting them in all U.S. package cars. The reader simply senses the package the moment it's tossed into the truck or moves past a checkpoint, no physical scanning required.
Right, it's seamless.
So when you multiply those 5 saved seconds by 20 million packages a day, you suddenly see exactly how they are slashing 25 million operational hours out of the network.
Exactly. The technology fundamentally changes the physics of how a package moves. But the innovation isn't strictly limited to physical sensors and robotic sorting arms. It's also heavily digital. UPS is expanding its Digital Access Program, or DAP.
I saw DAP mentioned as a massive revenue driver. How does that program actually function?
Think of DAP as the invisible logistics layer of the internet. It essentially embeds UPS shipping solutions directly into major e-commerce platforms behind the scenes.
So if an SMB is setting up a storefront on, say, Shopify, UPS is already integrated as the default frictionless shipping option.
Precisely. The merchant doesn't even have to go out and shop for rates. By integrating digitally, UPS captures that high-value SMB volume right at the source. In Q1 alone, DAP generated $1.2 billion in revenue.
That's incredible. And there's also the consumer-facing side of this tech transformation that directly impacts return volume, which historically is a huge headache for logistics companies.
The turns are usually a nightmare.
Right. But the sources highlight the expansion of their Happy Returns network to over 10,000 locations. This is super relatable. If you've ever had to print a label, find a box, and tape up a return, you know it's a pain.
Oh, I hate doing it.
Happy Returns allows for box-free, label-free returns. You just hand the loose item to the clerk, they scan a QR code on your phone, and the refund is instant. UPS then aggregates all those loose items into a single high-density shipment back to the retailer.
It is hyper-efficient.
But here's the friction point. All of these facility closures, the severance packages for 30,000 employees, the RFID sensors, the automated robotics, none of this is free. It costs serious upfront capital to build this network of the future.
Definitely capital intensive.
So how is this massive disruption actually reflecting in the immediate financial reality of the Q1 balance sheet?
This is where we have to look closely at the RPP, the revenue per piece.
Right.
The Q1 results are essentially the ultimate proof of concept that the better, not bigger strategy is actually working in the real world.
Okay, let's hear the numbers.
Total consolidated revenue for the quarter was $21.2 billion.
Yeah.
Now, remember what we established earlier. U.S. domestic volume dropped 8%, and international volume dropped 6%.
Right, and in a traditional volume-driven logistics model, an 8% drop in domestic volume would cause a catastrophic collapse in revenue.
Exactly. But that collapse didn't happen. The revenue held strong.
Wait, so even though they're physically moving significantly fewer boxes overall, their revenue per piece actually went up. What is driving that spread?
The spread is incredible. U.S. domestic revenue per piece grew by 6.5%. And the sources break down the mechanics of this growth precisely. A 340 basis point boost came directly from base rates and package characteristics, and another 200 basis point boost came from better customer mix.
Okay, let's translate those basis points into plain English for a second. A basis point is just 1/100th of a percentage point. So a 340 basis point boost simply means a 3.4% jump in revenue just from charging higher base rates and changing the physical characteristics of what they accept.
Right, like prioritizing smaller, denser, high-value packages.
Got it. And that 200 basis point or 2% boost from customer mix proves they are successfully landing those premium SMB and healthcare clients we talked about. They are actively swapping out cheap volume for premium volume.
Exactly. And the international numbers mirror this success too. International revenue per piece jumped an impressive 10.7%. Even with fewer boxes on the planes, the boxes they are moving are significantly more valuable.
Which is the whole point of the pivot.
Right. This dynamic of rising RPP against falling volume is what creates the specific margin progression management is promising for 2026. They refer to this timeline conceptually as a bathtub effect.
I love a good financial metaphor. How does the bathtub map to the calendar year?
Imagine the shape of a standard bathtub. It starts high, dips down low in the middle, and then rises back up on the other side. Q1 posted a 6.2% adjusted operating margin, putting us on the downward slope.
Because of all the heavy lifting we just discussed.
Exactly. The transition costs, the severance payouts, the facility closures, that naturally drags down the profitability in the first half of the year. Management expects H1 margins to hover around 7.5%, sitting in the bottom of the tub.
Okay, makes sense.
But as those automated building savings finally kick in and the high-margin healthcare revenue compounds without the dead weight of the old legacy network, they project the second half of the year, H2, to surge out of the bathtub to roughly 11.5%.
Here's where it gets really interesting. Because as an investor, management is essentially looking you in the eye and saying, trust us, the pain is temporary, the payoff is coming in the second half of the year.
Right, just hold on.
But Wall Street is notoriously impatient. How is UPS keeping shareholders from just jumping ship while they sit in the low-margin bottom of that bathtub?
They're keeping them on board with a very aggressive capital return strategy, specifically through their dividend. Despite undergoing the largest physical transition in a century and absorbing massive upfront costs, UPS reaffirmed its massive $5.4 billion dividend payout for 2026.
That is a powerful, tangible signal of confidence from the board to the shareholders.
It's a huge signal.
But when you dig into the math on that dividend in the SEC filings, it is incredibly tight. That $5.4 billion payout is backed by a projected $5.5 billion in free cash flow for the year. That is a 98.2% payout ratio.
Yeah, there's virtually zero margin for error there.
Right. They have to execute this network of the future flawlessly just to afford that check.
It is an incredibly tightrope to walk, and that tight cash flow is heavily impacted by labor mitigation, specifically the $1.2 billion cost of the Teamsters buyout program.
Which goes back to that driver choice program we mentioned.
Exactly. It saw strong interest and safely reduced those 7,500 full-time driver positions without forced layoffs. But it's still a $1.2 billion pill to swallow to right-size the workforce.
Which brings us to a major catalyst for that promised H2 margin recovery. The concept of lapping those elevated labor costs.
Lapping is so crucial here.
Yeah, if you aren't familiar with the term, lapping just refers to year-over-year financial comparisons. Right now, UPS's balance sheet looks weighed down because they just absorbed the massive upfront cost of that new Teamsters union deal and the associated buyouts.
Right, it looks heavy right now.
But by the time we hit the second half of 2026, that initial shock is 12 months in the rearview mirror. They have lapped it. The financial comparisons normalize, which mathematically allows the operating margin to expand back toward that 11.5% target.
That normalization is crucial to the entire thesis.
So let's step back and summarize the situation objectively. The company has a brilliant logical strategy. They are dumping cheap Amazon freight for Michelin star healthcare logistics.
Right.
They're successfully proving it with a 6.5% U.S. revenue per piece growth. The new automation is dropping costs by 28%, and the dividend is secure. So why, when they released these Q1 earnings, did the market react with a 3% pre-market sell-off? Why the skepticism?
Because the market hates uncertainty, and they severely punish stagnant guidance. Here is the bear case against UPS right now. Even though UPS actually beat top-line and bottom-line Q1 estimates, their earnings per share of $1.07 beat Wall Street expectations by 5 cents. Management absolutely refused to raise their full-year guidance.
A classic beat and no raise.
Exactly. They rigidly maintained their $89.7 billion revenue target and that 9.6% overall operating margin target for the year. When analysts pressed them on why they wouldn't raise guidance after a strong Q1, management cited geopolitical and fuel uncertainty.
And to a jittery market, citing uncertainty sounds an awful lot like management lacks visibility into their own promised H2 recovery. Let's pull a really critical data point out of the sources regarding that fuel uncertainty because it tells a fascinating story.
The fuel surcharge data is revealing.
Right, we just celebrated that 6.5% U.S. revenue per piece growth. But if you read the fine print, 110 basis points of that growth, so 1.1% of it, was artificially driven by fuel surcharges.
Yep.
That isn't pure pricing power from landing premium clients. That is just a pass-through cost because global oil prices were high. If energy prices suddenly drop, that specific slice of pricing momentum vanishes overnight, making those H2 margin targets even harder to hit.
Exactly. And if we connect this to the bigger picture, there is an ultimate operational risk hanging over the entire thesis, which is the macro ceiling. Global trade is currently showing signs of softness, particularly in Europe and Asia, alongside low consumer confidence.
And the danger here is a race between two variables.
Right. The entire strategy hinges on automation lowering fixed costs. But we have to understand how operating leverage works.
Let's break down operating leverage quickly. An automated facility has massive fixed costs. The robotic arms, the software, the real estate. It costs the same amount of money to run that building every day, whether it processes one package or 100,000 packages.
Right. And if global macroeconomic weakness causes their average daily volume to erode faster than their network of the future automation can cut costs, that operating leverage works in reverse. You end up with highly advanced, empty automated hubs that you still have to pay to maintain. The fixed costs crush your margins. That is exactly why analyst tone on the earnings call was described in the research notes as slightly negative to pressing. The market simply does not like waiting for a second-half promise when the macroeconomic ground beneath them feels unstable.
So, what does this all mean for you as you evaluate this transition? We've explored the Michelin star pivot, the 28% cost per piece reduction from automation, the incredibly tight 98.2% dividend payout, and the looming macro risks. What is the ultimate strategic takeaway?
After synthesizing all the institutional sources, the formal strategic outlook rating for UPS right now is execution-dependent core.
Execution dependent core.
Yes. On a structural level, the strategy is brilliant. The healthcare moat, with its demand for 99.99% reliability, heavily insulates them from cheap volume-chasing competitors. The 28% cost savings from automated facilities fundamentally lowers their break-even point. They are undeniably building a better machine. But the entire margin recovery thesis hinges entirely on execution in the second half of the year. They must successfully lap those labor headwinds, and they absolutely must hit that $3 billion cost-out execution target. If you are watching this company, you need to keep your eyes glued to the spread between revenue per piece and cost per piece in Q3 and Q4.
That spread will tell you if the ground level execution is actually matching the boardroom vision.
Precisely.
To quickly recap the journey we just took, we watched a 118-year-old Titan deliberately shed millions of low-margin Amazon packages to pivot toward a highly specialized menu of B2B and cold chain healthcare. We've seen them execute the largest network reconfiguration in their history, tearing down 27 older buildings, eliminating 30,000 positions, and rolling out RFID and robotics to achieve a 28% lower cost per piece.
A massive undertaking.
And they're doing all of this while walking a 98.2% dividend tightrope, waiting for the second half of the year to deliver the promised margin surge. It is a masterclass in trying to be better, not bigger. But I want to leave you with a final thought to mull over based on the research we've unpacked today.
Let's hear it.
If UPS is wildly successful with this strategy, if they prove that shedding massive amounts of cheap e-commerce volume to focus entirely on premium enterprise and healthcare is the most profitable path, what happens to the global logistics market if all the legacy carriers adopt this exact same playbook?
That is the million-dollar question.
Do the massive e-commerce giants completely internalize their logistics, leaving us with a fractured two-tiered system? A world with cheap, slow residential delivery on one side and premium, hyperfast enterprise cold chain on the other. It's a structural shift that could change how every single package arrives at your door in the future. Risk defined, portfolio protected.